Welcome back to a brand new episode of the Succeed podcast, hosted by yours truly, Dream Motivates, and my man Russel Thompson. Stay tuned. We'll be back right there. Welcome again to another episode of the Succeed podcast. Oh, Russel Thompson, he done took off his jacket today, fellas.
Yeah.
Ladies and gentlemen, he just took it glad. He said, listen, man, I'm pulling up my sleeves today and letting y'all know I got something for you. You know what I mean?
Mm-hmm.
And for the past couple of episodes, it's been amazing. Just learning so many different things. And I know for a fact that I've had to press rewind a couple of times. So hopefully you guys have been taking notes here in the Succeed podcast and having different guests come through.
Right.
And I just had the honor and privilege just kind of hang out with you, man, and learn from my own self and for my family.
Man.
So I just want to say thank you, man, for teaching the gospel right now, man, because we definitely are needing it because they sure ain't teaching this in school, man. So shout out to you, brother. Let's roll the play right now, man, because I know you've been in the kitchen and you ready to roar it out, man. I know. What's today's segment called?
Man, today's segment is going to be tax preparation versus tax preparing. So tax preparation is one thing and tax planning is another thing. So tax planning.
So tax preparation versus tax planning.
Big difference.
So hold on, tax. So you have tax preparers, and those are, is that H&R Block?
H&R Block, right? Those are people that you bring your
Liberty
taxes to.
Okay. Tax planners.
Tax planning means we're planning for the entire tax year. See? So the difference is that, people that are just bringing their information to a tax preparer don't get all the deductions. That's the difference. Tax planning people know what deductions that they're going to actually incur, and they're ready for those deductions. The categories are already in place.
Gotcha.
So now we can actually optimize our taxable situation because we're planning for our taxes, not just preparing.
So the tax preparers that are out there right now that are passing out business cards that says tax preparers, they probably need to change it to tax planning because some of them are really, letting people know all the codes, everything that you need to save the money. They're actually tax planners.
That's right. But here's the deal, Dream. 72%, or probably more than that now, of people that have tax preparers create their actual tax returns are the ones that are audited versus people that do tax planning.
Gotcha.
So tax planning is more on the line of monthly allocation. We're not waiting till the end of the quarter or the end of the year to figure out what we spent. We're allocating it as we go. So there's no error at the end, right? So it's so important, especially for Black folks, to get a person that does monthly accounting for you so they can write off everything that you really spent. Okay? At the end of the year, are you going to remember everything you spent?
How could you?
So you end up making false claims. Come on now. We don't make up things for our clients at the end of the year. Right? Because we involve them in tax planning.
Gotcha.
Got it? So we want to make sure that you understand the difference between a preparer and somebody that's going to actually put into your planning, right? Because that's a major difference, especially, again, if this is something that we're subject to do every year. This not going to stop. Taxes ain't going away. We're going to do this every year. We have to do it and make sure that we're in compliance on how we do it, okay? Now, some people say, well, I have QuickBooks, right? Kudos. That's the first place we start, right? If you got QuickBooks, man, you ahead of most people already. Think about this, because a lot of people don't have no allocation of what's going through their system.
Shout out to anybody that's taking all of their receipts and putting them in a whole QuickBooks, Analyze, man, what do y'all do? That's why it's good to hire somebody.
Thank you. So now you're meeting my point, because now, if I have somebody that I can now say, hey, Bob, I just bought some equipment at Home Depot. Bob say, I see it right there on your transaction. I got it allocated and documented. Now you're getting everything that you actually can deduct as an expense. And this is so important that we understand this. So, we think that little $175 or whatever it is a month that is hurting our business is actually helping our business, because we're able to actually write things off that we normally would forget.
Gotcha.
When we do tax preparation.
My CPA told me, she told me 6 years ago. She said, stop using any other card other than my business card, because it was coming. It was, saying, how it goes in business. You get it from here, you get it from over here.
Right.
She said, listen, stop. I need you everything on this one card, no matter what. And man, ever since I did that, she got it. Everything is shit, because it's all transaction.
And she's totally right.
She sees everything. That's right. A through Z.
Now let me ask you a question, Dream. What happens if I see on your bank statement that you put money into the business?
Based on the last episode, I could get double taxed. Gotcha.
Question is, that's exactly what you're right, what you just said. Most tax preparers are not going to go and look at your income to see whether you put the income in or somebody else paid you the income. The difference is that if you put the money in, that is not income. That is a contribution. Should not be taxed. So now when you plan for your taxes, come on. The person that's allocating monthly for you, they see everything. See? They can see that, this is an ATM deposit. He's the only person that got the actual debit card, so we know that's a contribution. Come on.
Got you.
I see a counter deposit or walk up to the counter, I'm going to make my point, that's the owner, right? You see? But if I have a Zelle come from Randy, come on now. But Randy only send me a payment, that's income. See? It didn't come from me, right? Or an owner of the business. It came from Randy. Now, what if Randy sent you some money, but you turn around and send Randy money back? That's not income from Randy. That's a loan from Randy.
Is that good?
Oh, that's excellent.
Got it.
Because it's not income.
Got you. And you can't tax them.
See? And this is where we're making a mistake with the preparers, because it's almost a rush job.
Yeah, because they're looking at
They're not looking at none of that.
And then that tax and that.
They're just looking at maybe all they're going to look at is your total income, all your deposits that you made in that year.
Gotcha.
They're not allocating what you put in, what was a loan, what's the contribution, what's income.
Because it's a lot. I mean, that's why he said monthly, right? Because if somebody's having to look at 365 days of transactions.
And you got 120 transactions in 1 month.
Okay, yeah.
It's impossible at the end of the year.
Yeah.
And you putting the pressure on your CPA and your accounting person.
Yeah.
And right? So we got to change it up.
I like what I was talking to Keidra. She's in here. Shout out to Keidra Jones in the building. When you said that, because I wanted to say this in this last episode, how separating entities is very powerful when you talk about Coca-Cola. And I was wondering how they use taxes on that, because you said Coca-Cola has different entities. Sprite is an entity, which is, I don't know if it's a LLC or by itself. I think that's what it is. So Coca-Cola owns Sprite. I think they own Dr. Pepper.
They own a whole lot of products.
They own it. So every one of those have different entities.
It goes through legal.
And it goes through legal. So if somebody has a problem with Sprite,
Diet Sprite,
and they try to sue Diet Sprite because it has something. Hey, the whole Coca-Cola situation.
You're not getting Sprite. You're not getting Coca-Cola.
Gotcha.
You're getting Diet Sprite.
So really, the thing is that every business have its own LLC.
Come on. That's why when you go into a joint venture, you always put in a company. We do not take money through Social Security numbers. We only take money from the public through EINs. This is, again, coming to your tax planning. Like you just said, Dream, sometimes we all over the place. We taking money here on this Cash App. That's a personal account. We taking money over here. Somebody got to say, wait a minute,
Yeah.
right? Let's not do it like that. Because you're causing confusion.
Gotcha.
Let's take business income where business income goes, right? And now we have a beautiful taxation situation here, right? So the planning for your taxes, ouch.
Yeah.
Let alone, we don't even want to talk about it, let alone even plan for it.
Gotcha.
All we've been doing is preparing for it.
Got it.
And it's costing us a lot of money. And in some cases, it's costing us audits.
And so all those people that's getting audited,
9 times out of 10, Doc.
what should they do if they're listening to this right now and they did get audited, you know, from a preparer versus a planner?
Right.
How is there a way to fix that or go back in, amend it or whatever? How do you go back in there?
Just depend on your situation. And so anybody knows anything about the tax code, you know, an S Corp, and that's why you keep hearing me talk about it, is a vehicle that a single member owned person can literally save thousands of dollars on taxes. Okay? So what you just asked me, you know, is that possible? Yes. There is a 3-year look back. You got 3 years to go back to actually claim yourself as an S Corp. So you pay taxes and you owe money in 21 and 22. If it owe money in 23, I can go back and say, no, let's be an S Corp now for 2021. Come on. Okay? The difference in the S Corp and the LLC is this, and this comes to tax planning. The LLC, anything that's left is considered a profit, and that's your profit, and you can't get around it. That's your income. So everything less out of whatever I expend, so in our 60, 25, 15, the 25% is already income to you, but now the 15% becomes income to you.
Gotcha.
Does that make sense? So even if you're operating in the 60, 25, 15 as an LLC C Corp, you're still incurring the 40% taxable liability. Does that make sense?
That makes sense. And then you were saying, and although I'm not going to ahead of it, but you're saying for beneficiaries.
Oh, man. Doc, it's a lower taxable income, right? Because a beneficiary is not an employee. A beneficiary is not claiming themselves as the owner of a business.
Gotcha.
They just a beneficiary. Therefore, the tax rate is a whole lot lower.
Gotcha. And so the tax planner
knows this.
Know that.
So now we're figuring out how to distribute money through your estate.
You know what? I think I know your method. I figured it out. Your method is you're going to tell everybody the game. But at the end, they're going to just be like, bro, can I just go through your company? Because
most people don't feel comfortable doing something they ain't never done before.
Yeah, because I'm telling you right now.
I couldn't do my own podcast because I ain't never done it like before, right?
Got you.
So I'm going to hire.
I'm big, like, man, one of my biggest lessons in life, man, is to understand. I remember when I first got my crib, right? I bought my crib and I was like 22 years old. And I was real proud. I went to Home Depot. And the first week, and I was like, bro, I got my own yard.
Right.
I'm about to mow this boy.
Right.
And man, I bought a lawnmower. I bought an edger. I bought a weed. No, it was a weed. No, I bought a lawnmower, weed eater. I bought some other stuff, a water hose. I ain't had no water. I ain't had nothing, right? And so I came over there, bro. And the guy, his name was Mr. Garcia. It was right across the street. And he was cutting his yard. He was inspired. That's what made me want to go get it.
Right.
I mean, he had the lines.
Right.
It's like, yo, Liddy. So I'm up there. I hit the joint.
Or at the line.
And I open the box up, man. I open it up, and I'm trying. I looked at how he pulled the string.
Right.
I see the string. I'm pulling the string. Bro, that mug is not
start.
Bro, my arm about to pop off. And Mr. Garcia's over there laughing at me. He come over there. He say, Nino, what are you doing?
Right.
I said, man, I'm trying to start this. He said, well, did you put the oil in? I said, oil? He said, yeah, you got to put the oil and you got to pump it. Prime the pump.
That's right.
And so he did it cut on. He started laughing. He walked back over. I said, dang. So now I'm cutting the yard. I'm messing up. It ain't looking nothing like
it.
So he come right back over there. So he grabbed it and he cutting it. It started looking just like, I say, dang. Then he walked back over. Now he's edging it. So first of all, I don't even know how to. So the edger, you got to put the little plastic joint.
Right.
Be mindful. My daddy wasn't there. Nobody taught me this. He ain't had no house. So he laughing at me again. He come over and do it again. He knocked it. I mean, it was perfect.
Right.
At the end of this whole situation, I learned a beautiful lesson. I said, Mr. Garcia, can I pay you to cut my grass?
Man,
instead of me trying to do it myself.
Go get supplies.
Bruh,
I know what I'm
when I tell you Mr. Garcia cut my yard for 15 years, cut my yard.
That right back.
I rinsed that joint down. Got my money. I took all the money that I bought.
Boy, that's a good point.
And I gave it to Mr. Garcia, and I said, I'm going to pay you up for 6 months.
That's a good point.
And he was like, okay. And then every time he cut his yard, I paid him up for 8 months. Every time he cut my yard, I took all the money. I gave it to Mr. Garcia up front. That way, we good. And, man, my yard and Mr. Garcia yard was the best-looking yard on the whole joint. And from that day forward, I always say, you know what? Pay the professional what they worth.
Man, Doc, that's it.
Pay the professional. I'm not trying to be the best lawnmower dude. He already got the game. Man, let me pay him. He good. Let me pay him. I'm not trying to be the best. My man is so good, man. I wonder what Mr. Garcia is doing today, man.
Man, bro.
I haven't seen him in so long, but he took care of me, man. And that's what people, when they listen to you, and now that I'm hearing these past episodes of what we've been learning, they just got to join. They just got to get down, dog. They just going to have to. That's why you do what you do.
All right. So, listen, we giving the game. Like I said, I'm giving you, I want you to know it because that's what they did to us. They kept it from us.
Yeah.
So, it's already something against us if we don't know it. But once you know, it's on you now.
Once you know, it's on you.
It's on you. You can make that choice now. You don't have it where now you just don't know. You now know, and you can operate in it. So, shouts out to Hennessy Tax Service, that does all of our tax preparation and tax planning, because we do have people come in at the end of the year. Of course, that's just going to happen, right?
Man, as a matter of fact, I think they sponsoring. So y'all stay tuned. Y'all check this episode out. Like, share, and subscribe. And we're going to get right back to you. Check it out.
Listen, have you found yourself in a taxable situation? Man, it might be where you owe the IRS some money, or you haven't even just filed your taxes yet. Matter of fact, you're probably looking for somebody to actually help you with your monthly allocation. Look, you don't have to look no more. Call Succeed Accounting and Tax. We're sponsored by Hennessy Tax Services. We do all your personal tax returns, your business tax returns, and even your trust tax returns if you have a trust. But we can do all that for you and meet all your needs for you. Again, Hennessy Tax Service. Now back to the Succeed Podcast episode.
Welcome back to another episode of Succeed Podcast. I hope you guys enjoy yourself. Listen, man, we are in the midst of greatness, learning. I hope you're appreciating the education that you would never.
Right.
I don't care how many Walmarts you would have to walk through and run into this cat to understand how amazing learning, and we're learning about tax preparation versus tax
planning.
And my man's breaking it all the way down. And
man,
shout out to everybody that, man, I hope you didn't get audited because you went through a tax preparer. But now you know, and like you said, now you know, then the
Tax
best thing
planning
is to
is best.
understand that's the way to go on the tax planning.
That's right.
So going into this right now, what I'm understanding, I've always been the guy that says, pay the professionals what they do.
That's right.
I'm not going to. I got a homeboy that no matter what, if something's going on with his car, even an oil, bro, first of all, an oil change, my man is doing his own oil change. I said, bro, I'm not doing Jiffy Lube, bro. I'm about to go to Jiffy Lube, catch that coupon.
Right.
And we've pay that $49.
And let them hold the liability.
Yeah, bro.
You see?
It's hot. My man got the towel down and the oil, you got to let the oil come out. And he got oil up on under his fingernails and hit him in the eyeball, and now he got to wear glasses. Bro, I'm not doing that. I need to take care. I need to go to the profession. So my thing is, my life plan is to have a personal trainer, a cook, a nutritionist, you know what I'm saying, a cook,
Boy, you on it.
a driver.
Come on, Dream.
Somebody that way, bro, I'm not, and then I can concentrate on what my gift is marketing. I can just, I don't have to worry about all this other stuff. I don't want to worry about all that, bro. I just want to concentrate on so the more and more I hear you, the more and more I just advise everybody, listen, man, not as a sidebar commercial, because if you can't do this stuff, he's giving you the game, so go ahead and do it.
Right.
But if you're like me, bro, we just need let's go ahead and get this consultation and let's succeed, do it, the whole joint. You know what I'm saying?
You know, like you said, man, the professional people are doing it every day.
Yeah.
If you're not doing the oil change every day, then you're not doing the oil change right.
I'm out.
See?
Can't do it.
You see what I'm saying? So he's wasting time and he's wasting the effort.
And he probably don't have the right tools either, man.
Exactly.
So you get in and out with.
Right. So a lot of wealthy people understand that I'd rather put my time in building more wealth than accounting for wealth. See, you're trying to do it yourself. You're trying to now take time for what you're creating to now go back to what you're accounting for. Come on.
Yeah.
When you just say, you know what, every entity that I create, it automatically comes with accounting. So if we go into a joint venture, Drake, how do we know what we make?
Yeah.
If there ain't no monthly accounting. How do we know what's really going on? We have to use a third party that you don't have no bias in, I don't have no bias in, that can account for us.
Yeah.
Does that make sense? So anytime you're going into a joint venture, people wonder why they're getting screwed out of deals and all that. Hey, start with accounting first.
Yeah.
Let a third party account for your business so that now a third party is telling you what you made or your percentage.
Exactly. Where you getting your bread at?
Right.
Yeah.
Not a person that, is in partnership with you.
Got you.
That's a major, we make a major mistake on that. So I want to also go into how tax planning benefits you. Because you think that, we think that, we just obligated just to go file our taxes and that's it. And again, there's more mistakes made in preparation versus planning. Does that make sense?
Absolutely.
You don't have to be a rocket scientist to know that, because you coming at the end of the year, you're going to miss something.
Yeah.
You can't remember everything, right? It's too much. Yeah. You spent you had too many transactions. So in the planning, one of the things that come up is, how do you maximize your deductions? And this is where, of course, the trust comes in. So right now, if you are a homeowner and you have your own house, that means you're only able to deduct certain things as a homeowner. The only thing you get to deduct on your mortgage is the interest. Dream, you don't get to write off the property tax. You don't get to write off the insurance premiums. You don't get to write off the maintenance if this is your primary residence. Now, if it's an investment property, yes. But if this is your primary residence, those things you cannot write off. That's why we move a property or your residential property into a trust. Because now, guess what? I can write off the property taxes. Come on.
Got you.
I can write off the insurance premium. Come on.
Just that one move.
I can write off the actual interest. Wow. I can write off the actual maintenance and the repairs of the property. You just talk about cutting that grass, right? That's an actual deduction, bro.
Got it.
In the trust, not on your personal. Did you hear me? I think the wealthy people got maids in the house. I think. Do they got maids?
They do.
They got maids. That's maintenance to the property.
It is.
Come on, bro.
And it's necessary.
Come on, man.
To keep it up.
I get to write that off of my trust tax return? Yeah. Can't write that off of my personal tax return. That's tax planning.
Got it. Got it. Got it. Got it.
You understand?
So you have to go ahead. And so for people that are looking at that, I know when you said that first, how do you, I know you got to put it in a trust, put it in a trust, but how do you transfer from a personal to a trust?
Through a quitclaim deed or a general warranty deed.
Got it.
Okay. Anybody know anything about real estate? The property does not have to be paid off for you to transfer the property out of your name. Come on. You can quitclaim deed the property into another entity and still owe a note. You can register your vehicle in another entity and still have a car note. Come on. Why? Because now we got tax planning involved. We are maximizing our deductions. Okay? Because we're planning for it.
Gotcha.
Not letting it happen to us. Right? So when you start looking at, protecting the assets and then the tax implication behind the asset, then I need to make sure that, I plan for that.
Yeah.
So if your house note is $2,500 a month, that's $30,000 a year that you got to take now as income just to pay for that property. What's the tax rate on 30% or $30,000? Oh, you're telling me I got to give Uncle Sam 12% of my money just to maintain a property? Let's let this trust on this property. Now I don't have to take $30,000 in Russel Thompson's name. Come on, man. Come on.
Gotcha.
I don't have to take that money now just to pay for this property. The trust just pays for the property.
Gotcha.
You see? So what we're doing is we're lowering what we have to take as income. We don't have to take as much. That's planning, man.
That's so powerful, bro.
That's planning, bro. You can't just pop up and say I'm alone.
So you've been doing this ever since you graduated, or
bro.
This is something you had to kind of live and learn. And
all experiences with businesses, man.
Gotcha.
The cool thing about succeed is this, y'all. You got to fail in order to succeed.
Man. And that's the powerful, look, I think that's a powerful
we failed on, y'all don't have to fail on them.
That's why mentorship is everything. Yeah, because you listen to a mentor that's already hit his head a couple times enough so you won't catch a concussion.
Exactly. We talked about earlier in one of the podcasts about the EIN number versus the Secretary of State.
Yeah.
People are bumping their heads because they got it first.
Yep. All the way back over. So listen to you right now for people that are listening right now and seeing the steps and probably going in and looking at the podcast, because I see what you're doing.
Man, come on, dog.
Go back to podcast number 1 so you can test the foundation. And here you are, tax preparing versus planning, and you need to be in the planning zone.
Come on.
With somebody who's educating you. The planners are educating you while they're doing it because they know.
Exactly.
You're probably going to say, so why do I do that? And they're going to tell you.
Exactly. You're getting somebody looking behind your shoulders.
Love it. Love it.
So remember we talked about that 60, 25, 15, right?
Yeah.
Right? So come around August, you got somebody to say, hey, you got that 15% in there?
Yeah.
Nah, bro. I'm okay. Say, hey. So by October, let's get the goal to say at least reach 12% of that. And then by December, we'll have the 15. So they're keeping you on point for the planning. To sustain the plan.
Gotcha.
No preparer can do that.
And that's crazy because it said the NFL, right? And it said the NFL really needs to stand for not for long. Because
the average person only
them boys get, I don't know, some crazy money. So like the sign-up bonus, then they get taxed on the money. Then,
oh man, don't get me started on that.
Man, yeah. Then
like, you open up a whole can of worms.
Yeah, of course they not.
So here's what happens with them: the signing bonus is a 1099.
Oh wow.
Now going back to this reasonable salary thing here. If you're gonna pay me as a W-2 employee, that's my reasonable salary.
Gotcha.
Why am I taking this signing bonus in my name?
So they should, they should, before they take the money,
my goodness.
before they take the money, they should say, they should get with Succeed. It's a shameless plug. And they need to set up a trust and they put their money in the trust.
Hey, Shaq, Kobe, Magic just did what you just said. They never
did it?
They done it. They've already done it.
Okay.
But they didn't take their signing bonuses. They trust took it.
See? And they watch this. Oh, powerful. They had people representing them to tell them what to do before they did that.
That's correct, sir. That's planning.
That's fire.
That's planning, Doc. So, again, you're having the planner is saying, hey, we got your reasonable salary locked in right here. But everything else you create, bro, we have a way to allocate that.
Now, see, that part, that's the part I cut for, because based on this 15, 25, 60, if you start off with, I mean, I don't know what these boys getting when they get in there. You start off with $1 million, you living off of, you can live off the, what's the 25% of $1 million? Well, let's go.
And think about that, man. You made $1 million and you only being taxed on $250,000.
Yeah.
That's huge. Now, everybody's always heard me talk about the S Corp, and we kind of hit on it earlier. But when you operate an LLC, you finna get the whole taxable liability for the 40%.
Gotcha.
That's the 25% that you basically took as a salary, and the 15% that you saved, Dream.
You can tax them.
That's income to you. Don't distinguish. But when I come into the S Corp, the 15% is not taxed as income. It's taxed as a distribution. Whoa, that's huge.
That's crazy, man.
So now I can save some money. Right? So look, real numbers. And this is why tax planning is all important. We use real numbers. Let's use some real numbers here. Say you make $1 million in your S Corp. Come on, Dre. So we know right now the allocation should be $150,000 should be in our savings.
Mm-hmm.
$250,000 should be in our actual personal account for our reasonable salary.
Yeah.
That means we were forced to spend $600,000. Now, that's a good force.
Right.
Come on, you forced to spend $600,000? Means you might need to go buy some real estate. Means you might go buy some more equipment. You see what I'm saying?
Yeah.
Means things that you need to go do to expand your business. Go buy it. Right? Go get you another lease for another location. That's what that 60%. And then it pays for your cell phone, food, gas. All that's in allocating that 60%.
Man, that's powerful, dog.
Okay? Right? Now, you are operating in this formula 60, 25, 15. As an S Corp, you're only taxed on the 25%. That's the difference between a C Corp and an S Corp.
Got it.
C Corp, you tax on the whole 40. So we go back to this formula here. On $250,000 salary, your taxable liability is $58,000. Now watch this. On the $150,000 savings that you had, remember, it's not taxed as income, it's taxed as a distribution.
Mm-hmm.
The distribution on $150,000 is about $20,000. So your total liability for the $250,000 and the $150,000 is about $78,000. Now, if you took the whole $400,000 or the 250 and the 150 on 400,000, you're now paying a higher tax rate.
Yeah.
Plus self-employment tax.
So you're getting double tax.
Plus the state tax.
Triple tax.
Does that make sense? I hope that makes sense to somebody, because this is why we plan for this stuff. Because now, so on $1 million, you know, I had $78,000 tax liability, but I still got $72,000 in my S Corp savings account. Now this is where state tax versus individual tax come in play. Because now, Dream, that's my only taxable liability. But I got all these other companies feed into my capital holding company. Come on, man.
Gotcha.
And these capital holding companies holding revenue before it distributes money to my trust, it's buying properties or buying an asset. But then it has to distribute money into the trust, right? Am I right? Now, we distribute money into our trust if you give beneficiaries money. We just talked about that. You hit on it.
Yeah.
And said that is at a lower tax rate. Did you say that, Dream? Other than income,
right way,
or other than employment?
Yeah,
it's lower. That is correct. So we distribute $60,000. Let's just say we did distribute $60,000 to your beneficiary. The taxable income on that is $6,000.
Come on.
How much money I got in my savings still? 72, huh? Watch this. $6,000 times 10 beneficiaries for taxable liability comes out to $60,000. So I'm going to distribute now $60,000 to 10 people plus my $250,000. Now let's do the math on that. That's $600,000 plus $250,000. That's $850,000.
Yeah.
Follow me?
Yeah.
What is my total taxable liability for everybody? Well, $78,000 for me and $60,000 for all 10 beneficiaries. That's $138,000, Dream.
Man, hold on.
Okay, now watch this. Man, I was able to pay
I see what you're doing.
Out of my 15% S Corp savings.
I got you.
Not only my taxable liability, but 11 people's taxable liability. That's insane. That's unheard of, untaught, and nobody understands individual taxation versus estate taxation.
Yo, listen, I hope y'all listen.
And I'm just doing my calculator here because I'm about to tell you what the tax rate is, because now that we can divide it
before we get out of here. What is it?
We can divide it before let me see it. Let me go to calculator right here. If we can divide this tax rate between 11 people versus 1, it's a big difference. So let's just think about it. If you made $850,000 on your own, 63% taxes if you live in Georgia, 52% taxes if you live in Texas. They making more money off of your money than you did. Okay. Well, let's just look at this. We spent $138,000 in tax liability divided by $850,000 in distributions of money. I'm even afraid to say this number on this podcast. 17%.
Look, we're going to drop the mic right there. We're going to be done with this.
Stop. Game over.
Listen, you're doing a disservice to your friends and family if you don't like, share, and subscribe. This podcast, man, this is probably one of the most fire. Shout out to the logo, man.
Man, logo, hey, Succeed podcast, baby. Hey, it's going down, man. You better like, subscribe, share.
Let's go.
All of that, right?
Man, we're right here.
And we're going to keep bringing it to you, right?
Yeah, man.
Man, if you love what you hear, man, share this with somebody.
Yeah.
Share this with, I tell people in their lifetime, you be sharing this. You should share this with 7 people in your lifetime, man.
Should.
Right?
Should, definitely.
Now, the last thing I got to say before we end is people do not plan to fail. They just fail to plan, bro.
Bars. Y'all heard it.
Okay?
Y'all heard it.
That's it, y'all. Planning is free.
Man, listen. Russel Thompson's in the building.
Bro.
Yeah, right here. It's your man Dream Motivates. Most definitely. Go ahead, like, share, subscribe. Check out the episode. Check out it again. Go back and rewind. Take notes. Share it with your friends and family. This has been rocked out here at Dream Media Agency.
That's right.
And make sure y'all get one of these fly shirts, man.
Represented job, baby.
Own everything. Hold on.
Own nothing, baby. Own nothing. Yeah.
Own nothing. I want to read and control everything.
That's right.
And all the principles that we're learning right now, super happy about it, man. I got my shirt. I feel like a part of the crew, you know what I'm saying? But we are in the building right here live. Go ahead, like, share, and subscribe. We'll see you next time. Let's go.
Thank you.